What if I told you that America's largest pension funds are about to make a move into Bitcoin? This isn't speculation. I recently sat down with Matt Cole on the TFTC podcast, a former CalPERS manager who spent 16 years managing $70 billion in pension money. He explains exactly why pension funds have no choice but to consider Bitcoin and when this shift might happen. Today we're diving deep into the pension fund crisis with someone who understands it better than almost anyone. Matt Cole isn't just another finance expert. He managed $70 billion at CalPERS, one of America's largest pension funds, and his entire family's retirement depends on the pension system working properly. What he reveals about the current state of pensions should worry everyone, but there might be a solution hiding in plain sight. I've spent the last several years at 1031 working with pension funds, and what Matt shares aligns perfectly with what we're seeing in the market.
Yeah, this actually is such a personal thing that you said to me, because my why for my career was trying to help fix the underfunded pension crisis in this country. As you know, I spent 16 years at CalPERS and started my career there because my parents, my grandparents, my uncles all had their pensions tied to CalPERS. And I graduated literally in the middle of the great financial crisis when the funded ratios of CalPERS and every other pension in this country plummeted, right? And right now they're 70, 80% funded. But yet they're paying out 100% to the current retirees, which if you do the math, if you're paying out of a system that's 70, 80% funded 100% to certain people, then the people on the back end are actually less than 70 to 80% funded.
Really hits on something important here that affects millions of Americans. He worked at CalPERS, one of the biggest pension funds in America, for 16 years. His whole family relied on CalPERS for their retirement. But there's a big problem. These pension funds don't have enough money to pay everyone what they're promised. They're only 70 to 80% funded, which means they're paying current retirees 100% of their benefits, while younger workers might get much less in the future. Think about that. If you're paying out more than you have, the math just doesn't work in the long run. It's like using a credit card to pay your rent. Eventually, you run out of credit. This is why finding new ways to make money and protect wealth is so critical for pension funds, and it's one reason why Bitcoin might be part of the solution. The situation is even more concerning when you consider that many Americans rely solely on their pensions for retirement. Unlike private retirement accounts, pensions are supposed to provide guaranteed income. When they're underfunded, it puts that guarantee at risk. Wait until you hear what Matt discovered while managing $70 billion at CalPERS.
We have a global debt crisis, right? Everybody knows we have this global fiat debt crisis, and it's something that the Bitcoin community obviously cares about a ton. I'm part of that community as well, and it's really what actually initially drew me into Bitcoin. Is I'm sitting at CalPERS and I was managing about $70 billion of their portfolio, all fixed income assets, and generating a yield of 3.5%, right? And you're sitting here, okay, like we have to earn 7% for the overall pension, and I'm making 3.5%. How do we actually make this math work? It just doesn't work.
Managing pension money isn't easy. Matt was in charge of $70 billion at CalPERS and needed to earn 7% returns to keep the pension funded, but he could only get 3.5% from traditional investments like bonds. That's a huge gap that needs to be filled. The pension system was built during a time when you could earn good returns from safe investments. Those days are over. We're in a global debt crisis where money is worth less every year due to inflation, and safe investments barely keep up. This forces pension managers to take bigger risks with things like private equity and real estate. At 1031, we talk to pension funds regularly about Bitcoin as a potential solution, not just for higher returns, but as a way to protect against inflation and currency problems. The old playbook isn't working anymore, and pension funds know it. The challenge is particularly acute because these funds have to balance the need for higher returns with their responsibility to protect retirees' money. They can't afford to take unnecessary risks, but they also can't afford to stay stuck in old investment strategies that no longer work.
We were talking about this before we sat down to record, but we've experienced this at 1031 talking to a bunch of pensions. These are large Titanic size ships that move very slowly, and you have layers of management and investment committee that decisions need to get pushed through. Not only decisions, but pitches, calls, follow-ups, and sit-downs. And it's historically, I mean, it's well known, they move very slow. And so I guess the point of bringing this up is how can we, in your mind, could urgency be engendered in pension funds specifically to to act on this. Because that's one thing I was telling you about Andrew Hones and battery finance. That's something Andrew and I have talked about over the last years. Is one worry is that, particularly this bull market, if things get crazy, we go into six figures, 100,000, 200,000, and then the pensions decide, all right, we need to move.
Getting large institutions like pension funds to try something new is incredibly challenging. I've experienced this firsthand at 1031 when talking to pension funds about Bitcoin. These are massive organizations with layers of committees and approval processes. Making any change requires countless meetings, presentations, and follow-ups. It's like turning a huge ship. It happens very slowly. The real challenge is that by the time they decide to move, the opportunity might have already passed them by. If Bitcoin hits $100,000 or $200,000, pension funds might finally decide to invest, but they'll have missed out on enormous gains. This is the challenge we face, helping these institutions understand Bitcoin before it's too late, while also respecting their need for careful consideration and due diligence. The institutional investment world operates on its own timeline, and that timeline often moves much slower than the markets. It's a difficult balance between thorough evaluation and the need to act before opportunities disappear. Sometimes being too careful can be just as risky as being too aggressive.
And it all feeds into each other. So if you get a little spot, you get a little venture exposure. Like the venture exposure, we would argue, is going to help your spot exposure because it's going to invest in companies that make it easier for people to adopt and incorporate Bitcoin into what they're doing. And then on the credit, like the credit side too, I'm very happy you mentioned the I guess we could call it complacency that exists on the fixed income side of allocations due to the fact that people grew up in this 40-year bond bull market, and the returns that are being provided in private credit, like if you're going to get high returns, you need to go pretty far out on the risk curve, where Bitcoin, if you look at Unchained's lending desks, like it's providing pretty good returns from a credit perspective, because I would argue it's an extremely mispriced credit product.
When pension funds do decide to invest in Bitcoin, they have several options. At 1031, we help build Bitcoin companies that make it easier for everyone to use and invest in Bitcoin. This creates multiple ways for pensions to get involved. They can buy Bitcoin directly, invest in Bitcoin companies through venture capital, or earn interest by lending against Bitcoin as collateral. The lending part is particularly interesting because it offers better returns than traditional investments with potentially less risk. Bitcoin-backed loans are secured by Bitcoin held in special accounts that can be sold quickly if needed, unlike traditional collateral like real estate or private company shares. This gives pension funds a way to earn steady returns while also gaining exposure to Bitcoin's potential growth. The key is understanding these different approaches and how they work together to create a complete investment strategy. What's particularly exciting is how these different investment approaches can complement each other. When pension funds invest in Bitcoin companies, they're not just seeking returns, they're helping build the infrastructure that makes Bitcoin more accessible and useful for everyone, which can benefit their direct Bitcoin investments as well. Let me know in the comments if you think traditional banks are prepared for Bitcoin, or if you agree with Caitlin that we'll see a major bank failure. I read every comment, and I'm especially interested in hearing from those of you who work in traditional banking or finance. And if you found this concerning, you need to understand how this connects to the broader war on Bitcoin banking. In my last video, I explained why pension funds are about to start buying massive amounts of Bitcoin and how this could force banks to improve their Bitcoin custody practices. The relationship between pension funds entering Bitcoin and banks mishandling Bitcoin custody reveals a financial system that's reaching a critical turning point. Click the video on your screen now to understand exactly how pension funds' Bitcoin adoption could reshape the entire financial system. If you want to stay ahead of these crucial developments in the future of money, make sure to subscribe to the channel where we break down these important stories every week. Stay humble, stack sats.